I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Well, let's get straight to the burning issues in private markets. Blackstone seeing opportunity in illiquidity at a time of growing caution. Plus, another cash-burning unicorn plans an IPO, testing the risk appetite of increasingly discerning investors. And how companies are dishing private planes, leading to the Uberification of the private jet business. Well, let's get into some of these burning issues. With me today, Bloomberg's Lisa Lee, Catherine Doherty, and Matt Townsend. Let's start with bankers from Deutsche Bank who have been weighing in on the potential distressed debt opportunities in China. Lisa, we've been hearing a lot about this with an increasing number of firms dipping their toe into China. What have the defaults been like so far in that region?
So far, China's default is pretty low because they don't really let their companies default, but President Xi has definitely decided to de-risk and de-lever some of the debt risk. And so we're finally starting to see the beginning of a possible distress cycle.
How big could it potentially be?
It could be huge. There's a huge amount of debt. Already last year, we saw onshore corporate debt record 20 billion. And there's about 334 billion of non-performing loans that the trade agreement that we just made with President Trump and President Xi could have US investors actually make direct investment into that. So there's a lot of possibilities.
All right, you've worked in Asia, and right in the aftermath of the financial crisis, a lot of people tried to dive in and get access to some of these opportunities. They didn't fare so well. Why is this time going to be different?
Well, I'm not sure this time is going to be different because even though there is a lot of distressed debt, the bankruptcy system is untested there. So we don't know. They borrowed a lot of the US bankruptcy laws, but how they will be applied, even in India, for instance, where Deutsche Bank, the people who sort of brought this up, has a big investment there, but already you have surprises and complexities because when courts have to decide, and you can't have a successful, healthy distress cycle unless you have a healthy bankruptcy system, and we don't know if that exists in China.
All right. Meanwhile, everyone's trying to figure out how much longer the rally in risk assets can continue more broadly. Blackstone's Dwight Scott, president of the debt investment arm, weighing in during an exclusive interview with Bloomberg's Eric Schatzker.
I don't think the things that drove last year can continue. It's a time, particularly in fixed income, to be a little more cautious.
Catherine, what's the issue here? What are they looking at that potentially could be a sign of caution?
Well, investors like Scott are definitely monitoring default rates at an increasingly higher amount. We're seeing that whether an issuer is downgraded, upgraded, there's a larger reaction, and that's across the board. It's not just with GSO. So it really, to me, is signaling that investors are taking these defaults and downgrades from S&P, Moody's, and they're taking them more seriously because there's a risk-off appetite out there.
Okay, there's one question about specific credits selling off in response to downgrades. It's another thing for the broad market to sell off, and we've seen, frankly, junk bonds continue to rally into 2020 after a pretty amazing year last year. What is the chances? Are we seeing any other signs of it stalling out on a broad base, or is this really idiosyncratic at this point?
Well, from what I hear from investors, they're basically looking at it and saying this can't last forever, this rally, whether it be in high yield, whether it be in leveraged loans. In the loan market specifically, that's what you're referencing in terms of these big downfalls, and those are really idiosyncratic. So it's based on these credits that have a lot of risk out there to begin with, but then there are updates or business restructurings that really have an impact, and that's where we see these massive losses in the loans and sometimes also in the bonds.
All right. Meanwhile, one cash-burning unicorn is looking to take advantage in the rally in risk assets by going public. Matt, do we have a sense of the timing for Casper Sleep? If you have heard of it, you probably have because it is known for its mattress in a box.
We don't have any timing details specifically. We basically know that the company at this point in its history is very unprofitable but growing pretty fast. So it'll be a good test of whether investors are up for that again.
So it's a question because they have been burning through cash, and in some ways, they are the first test of IPO markets since the WeWork debacle, when investors really pushed back. What is the potential risk here of them going, of trying to have an IPO right now?
I mean, the potential risk is that, just like you said, investors, stemming from the bad taste from WeWork, and just really looking at this model of company. It's what you call a direct-to-consumer company. There's a lot of them out there. They've been growing pretty quickly, but kind of hit this plateau where they don't become major brands like multi-billion. They get around to $1 billion, and it's kind of like, where do you go from here? And if you look at Casper's financials, they're about $400 million in sales a year, but they've spent about $400 million in advertising just in the past 4 years to get there. It's a very competitive market. Basically anyone with a website can become a mattress brand in this day and age. So it's like, how do you keep growing and how do you convince investors there is this path to profitability, assuming that investors are going to want to see something tangible that gets them to profits?
Okay, given how much liquidity there is in alternative markets, private debt, private equity, why would Casper want to file for an IPO?
Yeah, that was the big question, and we've been asking those questions, since they filed their S1, is basically, why now? Their financials, while they're still growing fast, about 20% through the first 9 months of last year, they were growing 40% the previous 2 years. And they don't have a great story to tell on a path to profitability. It's basically, look, we're going to get into more categories, we're going to expand geography, but it's not something that a lot of investors looked at and said, oh yeah, that's an easy slam dunk, I see their path. So it is a big question mark. Are they pressured by investors? Do they look at the debt market and didn't see that as realistic or that attractive?
Yeah.
So now they're going after an IPO.
Matt, thank you so much to you and to all of our reporters. It brings us to our next guest, Kelly Rodriguez, Forge Chief Executive Officer, which is an online trading platform that facilitates and brokers investments in shares of large private tech companies, or so-called pre-IPO companies. He joins me from San Francisco. Kelly, I'm so glad that you're joining us just to get a sense of how much the secondary market for these private shares has grown as we talk about the privatization of markets increasingly.
Well, it's great to be with you. The short answer is that the private markets are growing very rapidly. It's a huge market. There's about 1.8 trillion just in the top 450 companies. The last couple of years, we've seen volume expand primarily on the top 100 unicorns by valuation. We added about 34 new names in 2019. We expect 2020 there'll be significant trading in 300 names.
Do you think that the total volumes, first of all, how much has just the volumes and sort of trading activity increased over the past 5 years?
We estimate that the volume increase over the last 4 years is about 10 times on an annual basis. So we're in the sort of low double-digit billions per year now.
Do you think that it's going to grow exponentially, or do you think we've kind of reached peak privatization here as some venture capitalists and some direct lenders start to kind of pull back a little bit?
No, I think we're very early in the cycle. We've got probably 1,000 companies that will be of interest to the private markets over the next 3 years. Today, most of the market is trading in the top 100, so we've got a long way to go.
So recently there's been a bit of expansion away from just institutional investors trading these private shares amongst themselves and moving to making this more accessible to retail investors. Do you foresee a time when the average mom and pop investor will be able to trade these shares just as they would on the S&P 500, one of the large caps?
Yeah, there's two answers to that. First, just in 2019 and 2020, we saw large global wealth networks start to get into the space. So they're trying to find access for high net worth clients that are managed through wealth networks. I think what you're going to see in 2020 is you're going to see some very big name global products come to market, which will give a broader set of consumers access to the asset class in baskets so as to not have to pick a single issuer.
So in other words, indexed products on private shares, is that correct?
Index-like, probably initially part passive, part active.
Okay.
But that's where the market's going.
All right, so is it an ETF or is it derivatives? What are you thinking?
Well, there's already a derivative in the world right now. We launched a product with BNP Paribas last year that's already getting uptake in other parts of the world. You're going to see more conventional U.S. product structures hit the market in 2020.
When we talk about liquidity in private markets, how tested are these markets in an actual downturn when you do see liquidity dry up, even in the public markets? I mean, how much concern is there that these markets could become, could be pocked with a lot of potholes?
I mean, it's like any other market. We saw in the last 12 months with some of the very large IPOs that the trading prices that we saw in the private markets were higher or essentially stalled just before the company went public. So I don't think the conditions of a repricing or even a flattening will affect the interest in the broader access. I think it's a function of what people are interested in at the time. And right now, people are interested in fast-growing companies with a path to profitability.
Forge CEO Kelly Rodriguez in San Francisco, thank you so much for taking the time.
Thank you. It's a pleasure.
Coming up, Terrell Gates, the Chief Executive Officer of Virtus Real Estate Capital. He has a front row seat to the commercial real estate market, and he tells how that sector can be used as a market-neutral strategy for potential upcoming economic pain. And this week is World Economic Forum in Davos, where some of the biggest names in finance, business, and politics meet. The head of Canada's largest pension fund gave a warning for all other pensions.
I think the thing that I continuously ring the alarm bell on is not to be too invested in illiquid assets. So we have half the portfolio is in illiquid assets. We're very comfortable with our risk models and what we would do in various lurches down in markets. But I do worry about the expansion of a lot of funds like ours around the world into private illiquid assets.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. A lot of investors say we're in the late stages of the global economic expansion, and it's time to start preparing for what may be next. Our next guest has been advocating for a market-neutral strategy for a long time using commercial real estate. Terrell Gates, Chief Executive Officer of Virtus Real Estate Capital, joining us now from Texas. Terrell, what does a market-neutral strategy in the commercial real estate market look like?
It can mean a lot of things, but for us, we tend to focus on property segments that tend to be resilient in and out of cycles. And the way we ultimately got there was we looked at the underlying tenancy demand for these particular commercial property segments, and we were trying to find tenants that always had demand for that particular property type, whether GDP is +4 or down 4, whether interest rates are at 2% or 10%. That's kind of the idea. It's really about the resilience of the tenancy base.
All right, so you found student housing, senior housing, hospitals, that type of property tended to fit into that category. Am I missing anything?
Yeah, our three biggest buckets are healthcare, education, and what we call workforce housing, which is affordable housing for the middle income American.
So a lot of other firms, and I'm thinking even of, say, the Blackstones of the world, have gravitated toward these exact properties. And then you can throw in the warehouse properties as well with that. I'm wondering if that changes the equation, given the fact the valuations on these properties have gone up disproportionately in some cases.
Yeah, no, absolutely. We actually view it as a long-term positive for a few reasons. Number one, when the Blackstones of the world come in and the big sovereign wealth funds, you see liquidity increase precipitously. And so usually what happens is, particularly at large portfolio transactions, you see a pretty meaningful portfolio premium. Yet when you're buying more one-off and two-off, like we tend to do, you don't see quite as much of a premium on the buy side. So that's good when it comes to ultimately exiting. It also creates more validity or credibility for these particular categories. When we first started in these categories years ago, it was still considered niche real estate, and people were investing in them purely for better returns, not so much just because they have much more downside protection than traditional real estate. Now, because we're late cycle, so many new players are jumping in, to say the least, and have been for a number of years. Have you been selling into the rally? We absolutely have. And when you say rally, I guess we could say it's been about a 10 or 11-year rally. But we have been selling, particularly in large portfolio transactions. In fact, we've helped a couple of large sovereign wealth funds get into the senior living business and the student housing business. We've sold large portfolios to several of the largest private equity real estate fund managers out there. So it's been good for us. But ultimately, it comes down to the individual property opportunity and where you could add value.
Are you deploying the cash that you raise from these sales, or are you hanging on to it for a potential downturn?
Well, it depends upon which of our investment vehicles it comes out of. Some of these are closed-end vehicles where once you sell the asset, you're distributing the capital back to the investor. Others are more long-life vehicles where, yes, we would recycle into assets that we believe might offer a better risk-adjusted return at that time.
What are the returns like in these market-neutral strategies?
This really has that, what a lot of people like to refer to as that asymmetric return profile. These asset classes perform well in good times, like we've had for the last 10 or 11 years. They've performed particularly well during the challenging times, like the global financial crisis or the tech wreck or the 91 to 93 recession. So it's a wonderful thing in that regard, where you get the benefits in both good times and bad times. The challenge with these property types is they do tend to have more nuance when it comes to investing in them. They tend to have more operational intensity. So despite the fact that you are more resilient to economic cycles and black and gray swan events, you do have to be very mindful and careful about when, where, and how you invest in these property types. They don't really work so well if you're kind of new to the space or you're more of a generalist investor.
Terrell Gates, thank you so much. That was my conversation with Terrell Gates of Virtus Real Estate Capital, the Chief Executive Officer. Now, there's been a conundrum for many investors, both private and public markets focused ones. It does seem like the economic cycle is getting to its later stages, but many investors realize this, and they've been piling into safer assets, utility stocks, for example, in the public markets, or in this case, senior and student housing. There's a question, will these assets perform the way they have in the past as a hedge against the downturn? A lot of people saying, well, you have to have experience, you have to know where you're diving in order to get the same kind of benefits. Continues to be a question. We will continue to dive into it at this time of persistently low interest rates. Coming up, between the World Economic Forum in Davos and the Super Bowl here in the U.S., private jets are likely in high demand for certain flyers this month. Next, you will hear from the founder of Vista Global. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Well, let's talk disruption. The likes of Uber and Lyft have transformed the ride-hailing industry over the past decade. Vista Global is trying to do something similar in the private jet industry, offering pay-by-hour services for wealthy individuals and corporate executives. We spoke with the founder of the company about where he sees the biggest opportunities, including his intention to make acquisitions in the near term.
The overall market is about, the world is about 21,000 business jets. What we're focusing on is transcontinental and intercontinental. So the bigger airplanes, there's 7,000 out there. And in total, these airplanes fly about 2.5 million hours per year. That's that upper end of the marketplace, 2.5 million hours per year.
How much does it cost per hour?
Well, it really depends on the aircraft type and the size of the aircraft. So you're looking at anywhere between, call it $6,000 an hour, up to $15,000 to $16,000 an hour.
It's a fascinating business model because we were just talking about the concept of a shared economy and how people don't necessarily want to own a private jet, but they want to be able to use the services. Can you give us a sense of how private jets fit into that? How many people are being targeted by this type of business?
Well, I mean, look, it's a number of aircraft which are out there. And so if we focus for a moment on these 7,000 transcontinental, intercontinental jets, basically the fundamental issue in this industry is they're only used 250 hours per year, each one of them. A commercial jet flies about 4,000 hours per year. So the unit economics, if you only use an asset 250 hours per year, drives the cost to a very, very high level. And so what we did is we built a global infrastructure of a brand and identical airplanes, and we offer an alternative to ownership, hence asset light. And that drives the price down. It makes it more accessible and more affordable.
I'd love to get an idea of the scope, because we talk about Uber and Lyft and how they really have absolutely changed the game when it comes to hailing a taxi. How big is this market? How quickly are you growing right now?
Well, we're growing in average about 20% annually, the top line, and we see an acceleration of growth as we just bought XO here in the United States. We bought JetSmarter because we want to be in the forefront of this digitalization of the marketplace. You know, more and more people just want to go on the app and have an instant satisfaction, instant booking, and the unique feature of the JetSmarter application was that you can even do seat sharing. Now, what's the other very much undervalued asset is the cabin. There are only 2 or 3 passengers. Now you can actually invite more people right there on your app to join the flight, drive the cost down again, and then really tap into the first class and business class market as well.
How much competition is there?
Well, the biggest competition is the legacy aircraft ownership or buying a fraction of an airplane. And people just don't want to invest anymore into an asset. Think about a corporation. A board member needs to sign off on the acquisition of a corporate jet. That catches a lot of attention. It is financially a waste. So CapEx versus OpEx, obviously we're just operating expense because you pay for the hour.
There are a number of places trying to sort of serve this audience, this idea of bespoke private jet purchases. Have you been interested at all in making additional acquisitions to try to consolidate, as, say, Uber has done in getting market share?
I think you're spot on. We just did 2 acquisitions in 2019. There are other opportunities we're looking at in 2020. I think, you know, the consolidation is what we think at Vista Global. We really started in this industry. We're all about eliminating waste, and this has to be a very scalable platform. We are that scalable platform in the business, and if you add more revenue to the same platform, you have another opportunity to make it more affordable, because, you know, your unit economics are coming down, and they can pass part of that on to the consumer base.
So you are planning more acquisitions in the near future?
Dates, we're looking at a few of them, and we're looking at those opportunities as we speak. We'll be reporting back to you soon, I hope.
That was my interview with Vista Global founder and chairman Thomas Flohr. And certainly there will be a lot of private jets being used at the World Economic Forum this week in Davos, which leads us to our big number. At least 119 billionaires are converging on Switzerland. The elite group, worth about $500 billion, includes regulars like Bridgewater's Ray Dalio, Blackstone's Steve Schwartzman, and JP Morgan's Jamie Dimon. The irony is that some of this year's themes include sustainability and inequality, yet the people attending are growing their wealth at a disproportionate pace. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, and 2 a.m. in Hong Kong. From New York, this is Bloomberg.